Hi everyone, welcome to this new video on InterGlobe Aviation or IndiGo, which we might be familiar with. If you look at IndiGo as an overview, it's the first aviation company we are going to cover in our portal. In terms of MOAT analysis, it's been given a MOAT of narrow, right? This will be a super interesting section to dive deeper into. The quarterly score was very bad. This is a Q3 FY26 score. Of course, there was a major operational disturbance in December, which we'll also dive into. The growth prospects are not looking great. It's a score of 7.1 from a lens of FY26 to FY28. So it's the growth rank has been 88 out of 93. So that's not really good. And we'll try to understand what's the future growth looking like for this company. In terms of guidance, the management has been given a high trust rating as in relation to the guidance that they provide. And the guidance is usually based on capacity, and for FY26 the capacity growth has been given in early teens, right? So having set the stage of what are the discussions we're going to do, let's dive into the analysis of InterGlobe Aviation. So the aviation sector, if you look at the value chain, this is very interesting. There are the aircraft and engine OEMs, right? Now, these are very concentrated. This is a very concentrated layer of the value chain. Airbus and Boeing are the major aircraft manufacturers, and in terms of the engines that are put in these aircrafts, there are majorly three companies which are there, where Pratt and Whitney is listed. There's also Rolls-Royce. There's also a JV between GE and Safran. So this is one thing about this layer. Another interesting thing about this layer is the margin is very rich. It's the richest across the value chain, right? This is probably the part of the value chain where you would want to be at. Also very interesting is in terms of the engines, these engine makers have the engines itself are low margin business, but the aftermarket franchisees that they have, which is in relation to services and spares, are actually much higher margin, and they sometimes kind of make up for the losses in the engine sales itself. So that's a very interesting way of it's almost like a subscription based model where you sell the engine, but then you actually earn on its maintenance and other things, right? Then of course there's the lessors and financiers, and initially I was thinking, is this really big enough to be in the value chain? Is it distracting us from value chain analysis? But then I found out that almost 50% of the planes globally are leased, and in India the number is up to 80%. So these are a big part of the value chain for sure. The lease yields here are 9 to 12%, which is not good, not bad, right? Then comes the airlines, of course, which are responsible for either buying or leasing the aircrafts, and then they eventually sell tickets to people like us, and they are the ones which carry the risk of fuel, they carry the risk of forex, and then they pay obviously the raw material, which is the planes. And then they also pay the airports, ADC and ground infrastructure. So this is the final layer where they basically operate the runways, the terminals, the ground handling and refueling, right? So the margins here are adequate, and these companies kind of derive the revenues from an aero and a non-aero verticals, right? And if you look at something like Adani Airports Holding, so in Mumbai it's roughly 50-50 division. But in smaller airports, 75% of the revenue is coming from aero-dominated services, right? So that's also an interesting business to study. The margins are adequate, right? Nothing special about having these kind of businesses. In terms of the pinch points are definitely the consolidated industries. There was Pratt and Whitney, there was some problem with their engines which led to almost 70 aircrafts getting grounded, and that led to a huge pressure on these airlines, so this is the it almost chokes the entire value chain. And then there are also in the fourth layer, the metro airport slots are very scarce, right? So that's also a problem. Okay, getting a little more knowledge about this industry before we dive deeper, there are some business models at play. There's the LCC and there's the full service carriers. So LCC are low cost carriers and full service carriers are obviously FSCs. So Akasa, SpiceJet, Air India Express would be your low cost carriers. So they usually have the same aircraft fleet so that the maintenance is kind of optimized. So everything is efficient so that the prices are lower. They'll not offer business class. They'll try to cut costs at all spaces possible, right? Full service carriers will offer, there'll be a first class, a business class, there'll be free meals, there'll be an alliance. So alliance membership is Air India specific, but they will provide you with the full services. And now IndiGo's kind of gone in the hybrid layer where it was the LCC, it was the LCC dominant player in India, which is now slowly bringing in aspects of the full service carrier, which is very interesting because IndiGo made its name being an LCC, and now that they've reached a certain scale, and now for future growth, they need to expand to international markets, or now they've been almost forced to adapt these full service carrier, become a full service carriers to maintain their growth trajectory. So it's very interesting if you think about it this way. Then your Akasa and SpiceJets will mostly be domestic players, right? Your IndiGo and Air India Express will be domestic dominant, but they also have some short haul international routes that they operate on. And then there are your, like Air India is obviously used to be the national carrier. Now it's being run by Tata. In terms of industry regulations, now this is very interesting. There have been some regulations changes. What happened was a few airlines have gone gone under insolvency in the last decade or in the last few years, and that's the nature of this airline business for a long years across countries. It's not an industry someone wants to, it's a tough industry to be in as an airline operator. And in India, what happened was as I said, 80% of the aircrafts are leased, right? And the leasing fees that are charged by companies on Indian Airlines is 8 to 10% higher because of the insolvency experiences which Jet and Go First went through. These leasers had a pain in recovering their leased aircraft, so that's why they were charging a premium to Indian players like IndiGo. So there were some regulation changes made in order to compress this premium which was being charged to Indian players. Now, DGCA passed a compliance where they tightened pilot duty time, night flying limits, weekly rest. These are all good things, and this was also passed in FY25, 2024. 1.5 years later, this act led to the disruptions in IndiGo, where so many flights were cancelled. It affected 10 lakh passengers. It was a crazy time in December when the repercussions of this industry regulation actually played out for IndiGo, because IndiGo is very efficient, right? It's wanting to use its pilots also in a very effective way, and then due to these regulations they couldn't use their pilots and they had to give them off time. So there's effectively a pilot crunch which is being created in the industry due to this, and also due to the structural growth which is happening. And then there's the taxation issue is also present in this industry. The taxation is state VAT is levied on ATF on their turbine fuels. Now turbine fuels are 35 to 40% of the airline cost for Indian Airlines, right? But 25% globally. So Indian Airlines are paying much more, are having much more cost for their fuel, for their raw material. And one of the things is because state VAT is levied on it, which now of course there was a cut, which is why this regulation is positive, but still it's not under GST. So there's, in terms of taxation, they're not able to get some credits for that. So they're still paying a premium, even though that premium might have come down, So yeah, an industry which is definitely impacted by regulations, as we can see, or the dynamics are affected by regulations, as we can see, right? Okay, moving on from regulations and looking at the subsectors, there are basically two subsectors which have been identified here. That's the domestic aviation and the international aviation. And these are good to study differently because the dynamics are slightly different in terms of the slots, in terms of the competition. The dynamics are different, so it's good to analyze these two differently. In terms of domestic, IndiGo is a leader, 64% market share, but Air India is catching up. I think there has been, Air India is closing the gap in terms of marketplace, that Air India Express is kind of modeling what IndiGo was as an LCC. So this is an interesting story playing out in this industry. Also, what's very interesting is there's a concentration showing up in this industry. Go First and Jet have gone out. SpiceJet is distressed. There's one new entrant, Akasa, which has come in the last 5 years. And with the Air India merger, there's almost been a concentration where now two groups are owning 90% of the market share, right? So this is very interesting. The returns are not very, very nice, that they will attract competition. So can we say that this industry is kind of going towards concentration and we might not see new entrants in the new future? It is possible, and those dynamics will be very interesting to see, because ideally in this case the concentrated leaders should see some benefits in terms of pricing. They won't have to undercut each other. There can be some healthy pricing which can be maintained by these two groups, since they are the leaders. So this is a good sign for this sector. Everything else being constant, this is a good sign. Obviously supply is tight. If a new industry or a new entrant wants to come in, where will they get the aircrafts? Aircrafts have been booked for the next decade. I don't know, like, it's so crazy. IndiGo itself has a backlog of 900 orders, which is one of the largest in the commercial aviation history. And I was looking at it, they will go from 440 aircrafts to 600 by the end of the decade. So even though they have 900 aircraft orders, this will probably not be fulfilled even for the next 10 years, which is kind of crazy. In terms of international passenger aviation, this is also an interesting dynamic. And international passenger aviation, the market share has been calculated using the international passengers in and out of India touching, right? So in that, Air India is leading at 23%, IndiGo is catching up at 17%, but obviously Air India is operating the wide body long haul flights as compared to IndiGo. And then what happened was Jet Airways collapse led to a gap in the market in terms of supply side, and most of that market share was captured by these foreign carriers, right? So Indian international aviation doesn't have a good representation of Indian airlines, and now I'm not saying that should be the case, but this is just interesting that Indian airlines are not dominating this space, and the foreign players have kind of taken it up. However, there seems to be some sort of recovery on this phase where IndiGo has ordered a lot of wide body aircrafts, and it's also expanding into the international markets. It just had a recent flight to Athens, and it's going to open up more routes soon. So Air India is also trying to catch up in this sector, right? It's been the dominant India player, but it's trying to get more space as well. So the rebuild is in the early innings, right? But it's just super interesting to know that these foreign carriers are taking up almost 40% of our market share, right? Okay, yeah, we've dived deep into the industry and we've learned quite a few things IndiGo specific as well. And now let's see how that plays out as we discuss the business next. Alright, so InterGlobe Aviation operates IndiGo, which is the largest passenger airline and the dominant LCC in India with a 64% market share, serving 96 domestic destinations, 41 international destinations. So that's quite a lot. It's not like one or two destinations internationally. There's no business segment reporting in this company. 90% of their revenues are coming from ticket sales and 10% is coming from some ancillary things like baggage and fuel and all of that, but it's basically it's air transportation where their revenues come from, right? Now going on to the competitive moat. The competitive moat has been said as narrow moat, right? If we look at the economic proof, their returns appear to be above the weighted average cost of capital. So for the last 10 years, their returns have actually fluctuated a lot, you know. They have also been battle tested by COVID and by this recent operational event. So they have kind of gone up and down 25%, 6%, this and that. So basically what I'm trying to say here is if this airline or if this company really had a moat, there wouldn't be so much volatility in its in the economic proof of that moat, right? So basically, unfortunately, it's also the industry is such that it's tough to have a wide moat also. But just by looking at some proof, we would say, okay, it's a no moat to narrow moat candidate. It's definitely not a wide moat, right? And with that base set, let's try to see if there are some sources of moat. So when we look at the sources, definitely switching costs and network effects don't apply, but the intangible assets apply, you know. And those intangible assets are what? They have the slots in the domestic, so in domestic airports, in the prime time, only certain aircrafts can take off, right? There are limited runways, there's like in 450 to 530, maybe 3 slots are there and where aircrafts can take off, right? So those slots are very precious, and IndiGo has some intangible assets over there in terms of the slots that they have, right? So this is the domestic aviation sector that we're talking about. Also there is some brand presence. IndiGo is known for being on time. I mean, other airlines don't have such a, in fact have a bad brand image. So IndiGo might benefit in the way like it can't price its tickets higher because of its brand. But I think if in a similar price range, people might prefer IndiGo, or if it's slightly more, people might prefer IndiGo just because it's always on time and there are no delays, right? So there is some level of intangible assets present. In some terms of cost advantages, definitely. This is the big one, right? They provide, so the scale, IndiGo is the LCC model for India. It's the reference point for India. They have, most of their planes are from Airbus. It's the same fleet, so maintenance is better. Their cost, their cost metric is 4.73, which is supported by a young fuel efficient fleet of the Air A320neo and A321neo, right, which reduces the largest expense fuel, right? So definitely the LCC advantage is there, it's strong, and it's also durable because it will take some time for a new entrant to come in and build up this 400 plus aircraft fleet and kind of have those same economics. Now Air India Express, now the very interesting thing about both of these sources are both of them are under threat, right? In terms of intangible assets, Air India Express can match them for slots, and there can be, at least there's one viable competitor. And with the operational event which happened in December 2025, the brand might have taken some impact. And in terms of cost advantages, the costs seem to be going up for IndiGo, which we'll see in their metric. Again, here they might be under attack by Air India Express, so market share might be going to Air India Express in that way. So they do have durable moat sources, that's for sure, and that's where the overall verdict kind of shifts from no to narrow, right? Driven by the scale-based cost advantages and a regulatory barrier found by airport slot control. So that's the moat verdict on IndiGo. Very interesting read. Okay, in terms of the quarterly score, obviously it had a very low score in the last quarter. What happened was there was a major operational crisis resulting in 2,500 flight cancellations, significant penalties on top of that, and customer compensation costs. However, there was good news as well. They strategically expanded in long-haul international routes. commenced by the induction of this new fleet that they've also ordered and new routes like Mumbai Athens. So this is such a nice event which happened last quarter, but it was dwarfed by the other major operational crisis which took over. Results: 6% increase in total income. EBITDA margins contracted 85%. Reported PAT plummeted due to one-offs. A labor code was also there last quarter. So what's the rationale behind the score? Normalized profitability declined 18% YOY, indicating significant margin compression. Unit economics deteriorated. The revenue fell 4%. So this is the revenue per available seat per kilometer. So this fell 4%, driven by a 1.8% decline in yields and a 240% drop in load factor. So this is very interesting because it's been 1.5 years since their stretch, which is their premium pricing, their business class segment was launched, and ideally it should lead to better yields for them because they are selling these seats at higher prices. But what we are seeing is the revenue is in fact down 4%. Well, it is down also because of the yields. There's 1.8% decline in yields, and also in the load factor, which is how much of the seats they are filling. So it's kind of there. It's not looking good in terms of this metric alone. Guidance, the capacity growth is what they guide on. It's been projected at 10%. I think we'll look at the guidance again in the next section. But yeah, this was the quarter from there for them. Not easy, definitely. In terms of the key variables, the passenger load factor has been declining. It kind of saw some recovery, so this is good. Utilization, we'll have to monitor how this is, but there's also not massive drop-offs, right? The cost factor is going up. This is not good. So this is the unit economics that we were talking about. Strategic market pivot is also there. So they are now expanding into the international markets. That can be seen in the international ASK share and aircrafts on ground, right? So this is what happened in, I think, 24, where Pratt & Whitney had some issue with their engines. So all these aircrafts had to be grounded. And that is a problem for airlines, right? This is the structural pinch point that these OEMs have in this entire value chain. So what happened was IndiGo had to almost ground around 70 to 80 aircrafts at peak. Obviously, they leased aircrafts and kind of continued on their route operation, but it's not good. It's it's not efficient utilization. It's of their raw material. If 80 of their, or almost like 20% of their fleet is grounded, right? It's additional costs. It's not great. So yeah, we can see that the count has been decreasing from 80 to now it's almost half, but still there's room for expansion, right? We'll go on to the growth metrics next. All right, in terms of growth metrics, what's happening is if you look at the top 3 growth catalysts, as I said, they are expanding into international long hauls, which we just saw with the launch of the Mumbai-Athens route, and also they have ordered a lot of aircrafts for the long haul narrow body operations, right? So this is one of the growth catalysts. It's in delivery, it's ongoing, revenue impact will be there, there's high confidence, right? There is a higher yield potential, and range expansion to 7 to 8 hours addresses underserved Indian international market with a low cost base, right? So there is a potential for higher yield in these long haul flights. They're also doing the premiumization through stretch business class, dual class configuration to 65 aircraft across the busiest routes, increased their revenue per seat per kilometer available seat. As we saw, it's been 1.5 years, but the metric is actually gone down, so it's not really had an effect yet, but let's see. I think there's one more. They've ordered, I think, a lot of fleet ownership and financing optimization. Also, another aspect is the industry consolidation. So all these growth catalysts are there, but what the scenario analysis is telling us 10 to 12% growth, right? This is based on the ramp up of their international businesses, continued double digit capacity expansion, 10-12%. Obviously, the downside can be if Air India is kind of becoming very good and taking away market share, or of course, the fuel forex risks are always there. So, if they come into the picture, that can be bad. In terms of the guidance, the company there is a big picture growth also, where primarily they want to transition from domestic to a global aviation player with significant wide body operations. This is the shift that we are seeing. Obviously, there's been a high trust where they've beaten FY24 guidance, they've been in line with FY25, but FY26 has not been good. Early teens capacity growth for the full financial year was upgraded to early teens. Early double digit was upgraded to early teens, but Q4 guidance was moderated to 10% following the operational disruption. So there's been a mid-year cut in the revenue guidance. In terms of the tracking items, there are a few things which are being tracked, right? But overall, this is the story of IndiGo Airlines, right? Of InterGlobe Aviation. InterGlobe Aviation saw a peak FY24, peak profitability, record revenues. They also saw almost a collapse due to COVID. So it's been such a wild ride. And anyway, operating in an industry which is probabilistically not in your favor, it's very interesting to see a player who's actually taken lead and who's actually been profitable. It's a very, very tough industry to survive in, let alone be profitable in. So the story has been such, it's been an LCC model, a reference point for other airlines. It's seen profitability, it's seen cycles, it's withstood challenges, and now we can see it going into another layer of operations with it becoming kind of a hybrid with the LCC and also the full service carrier model, right? Expanding into internationals, seeing some cost pressure on its LCC, on the existing verticals, but trying its best to manage it. It'll be very interesting to see if they can maintain their strong position in the LCCs while kind of getting good gains in the new ventures they are venturing out into, right? So that's the story of IndiGo Airlines. Thank you.